Hello. In this episode, we examine some features of informal finance and begin our examination of microfinance. In background, Chapter 15 considers finance and fiscal policy in a broad way and finds early on that there are requirements for financial systems in all economies, from the lowest income, least developed country to high income, developed countries. The chapter explains and examines several differences between financial systems in these range of developing and developed countries, as well as differing fiscal matters as well. And these give rise to a number of policy and program issues. And one of these key issues is that many, if not most, low-income people in developing countries continue to remain outside of formal financial systems, such as a formal bank. Nonetheless, most people still have some significant needs, whether met or unmet, for financial services, such as the ability to get a loan when the family needs one. For example, very important example, micro-entrepreneurs, of which we've seen there are so many in the world, need working capital so they can be more productive. It's still common to find micro-entrepreneurs selling a very limited number of goods and range of types of goods, and really relying on the chance opportunity that somebody will come by on the street or in the market who has a demand for what they are selling. Whereas with more funds available, they could carry a larger inventory and ultimately be more productive, meaning they'd have higher income. Also, micro and small firms can lack the capital that they need for buying, for example, a sewing machine or some other relatively low cost form of capital good, but nonetheless is out of reach for those people. They need to borrow, but banks may find that the amounts they want to borrow are just not big enough to be profitable, or the bank may have no way of knowing that whether or not the borrower is a good risk, somebody likely to repay. So in all of these cases, there's a problem in going to formal financial systems, and the alternative has been the traditional money lender. But unfortunately, traditional money lenders tend to charge potentially extremely high rates of interest, which is a great burden on people living in poverty. These numbers can be as high as 30% a month. Also, the poor need safer ways to save. The savings of the poor all too often are stolen. In addition, there's a high need for some basic forms of insurance. We looked at the need, for example, for weather insurance when we examined issues in agriculture and development in Chapter 9. So we can see the great importance of finding ways to get financial services into the hands of those who are lower income. One of the strategies used among those people throughout the world, Latin America and the Caribbean, North Africa, Sub-Saharan Africa, South, Southeast, and East Asia, is the rotating savings and credit associations. They take somewhat different forms, but all operate with some similar principles. With these, a group is formed for a period of time. It might be for a year, and they meet, for example, weekly, in which everyone pools in a fixed amount of savings. It might be $3 a week or something of this nature. So each member adds this to the kitty, and then it's allocated to the members on a rotating basis. So if there's 50 weeks, one might draw straws to see who gets it in sequence. Or the sequencing of who gets to borrow or to receive the funds, not borrow at that point, but receive the funds, may be based upon individual bidding. So a borrower who has the means and the need to have that money more quickly may get a chance at doing so if they add additional money into the total future kitty, for example. And so clearly there's an incentive that after you receive the kitty, you might just walk off rather than continue to come and put in your $3 or $5 a week or whatever the amount is It may be, but this turns out to be quite rare in practice, in part due to the way that the potential members of these groups form. You may not know everyone in the group, but you're likely to know at least a few people in the group who know a few others, and so on. So there's some social capital typically involved, though not always. And so at least one participant receives the pool, and then they can use it for any purpose. You might use it for school fees that otherwise you'd have a hard time accumulating enough funds for. A sewing machine, paying off debt is quite common, for a holiday or other special wedding, for example, party costs. So for a whole range of things. And so many prefer to save and borrow if you want in this way. Participation is quite active. Many people and throughout developing countries. So it's important to understand how they work. Well, one important thing to note is that the ROSCAs do provide funds faster than saving the money would. And so it's about half the time on average, because your turn to get the kitty is on average halfway through the year. And then you can use the funds and deploy them right away for your intended purpose. And so savings is more common through this method than you might find otherwise. For example, a careful study in Kenya found that participants did not increase their savings when they were given access to formal savings accounts, but they did when given access to a ROSCA. So this is telling us something. One thing is that this is consistent with self-commitment devices of the kind that we encountered, for example, in Chapter 8. This is noted particularly by behavioral economists. There's a temptation, in other words, to spend the savings that you're doing before you get to your really desired target, for example, of paying for school fees or a sewing machine. And so in this case, you're giving the $3, the $5 into the kitty every week, and so you don't have access to those funds for smaller purchases until it's your turn to receive the kitty. So this reduces risks of impulse purchases, but also reduces risks that family or friends, knowing that you're saving money, put some pressure on you to address what is perhaps a legitimate need for the funds, but may mean that you never reach your goal otherwise. Another aspect of this is that women control savings rather than the husband. Once you've put it in the kitty, the husband doesn't have control over it. And this, so that these funds that are saved, in effect, can't be withdrawn until the kitty is received, at which point the woman might be able to more readily use the funds for the purpose that she intends. So this is something about the background for ROSCAs. Then, with respect to microfinance, the best known part has to do with microcredit. And the best known approach with microcredit are group lending schemes. So in the remainder of this episode, we'll look at microcredit schemes, and then in the subsequent episode, we'll look at some microfinance alternative ways of organizing lending. And so microfinance, it provides financial services to people who otherwise would not have access or would only have access on extremely unfavorable terms. It does include small loans, microcredit, also micro savings, opportunities to save a little at a time, perhaps by someone who comes around and collects small amounts of money from the neighborhoods for the bank, and then micro insurance, such as some of those providing, for example, weather insurance in some developing countries. So providers for these services are often referred to as microfinance institutions. They take a wide variety of forms. They may be NGOs, they may be cooperatives, they may be private banks in some cases. And also, in addition to making small loans for micro entrepreneurs, for which these microfinance institutions are best known, they're also used for consumption smoothing. Maybe someone loses a job or is temporarily ill. There's still a need to buy food. For consumer durables, as really is always the case and remains the case in developed countries when people buy consumer durables on credit, of course, and some other conventional loans. So the essential idea is that there's three factors that make it difficult to relax credit constraints that are impacting the poor. One is that these micro entrepreneurs often have insufficient or, if any, viable collateral to offer. One dimension of being poor may simply be to lack collateral, because that can lock one into poverty without this access to credit. So that's the first point. Banks are not very inclined to lend to borrowers unless there's some collateral. So also, it's difficult for conventional lenders to determine borrower quality. It may be difficult just to look at a group of potential borrowers who may all look poor to the banker and just have some sense about who's more reliable, who is more ethically perhaps committed to repaying loans, just determined as a matter of principle to do so, as well as greater business acumen, greater opportunities for actually being able to make enough money to repay the loan. Very difficult for a bank to do that. Finally, small loans are more costly to process on a per dollar lent basis. After all, you have to collect some of the same information whether you're making a loan for $1 million or a loan for $30. You have to find out the person's name, where they live, some references, what they're planning to use the loan money for. Some security has to be worked out. And so even if there is collateral, small loans may not be made because it just takes, for example, too much staff time to do the background needed to make the loan. So microcredit often and most famously uses group lending schemes, which in effect address all of these problems, at least to some extent. A group lending scheme is a form of joint liability in which each of a group of borrowers must repay the other's loans if for some reason they do not do so. And so joint liability plays an important role. First of all, it to some degree represents an alternative to the lack of collateral. It represents what can be called the collateral of peer pressure. You know that if one borrower is having a difficult time repaying, is thinking about perhaps defaulting, they're likely to get some strong social pressure from the others in the group who are otherwise going to be responsible for repaying the loan if there is a default. So that's of great significance as well. Moreover, the group that you sign your loans with are much more likely to know each other, know each other's character and intelligence, business acumen, but more precisely, specific opportunities. And so this is more readily observable to people in the village than it is to an outside bank. And then finally, much of the most basic work is done by those borrowers in these microcredit associations. For example, the borrower groups collect and pool the amount that's owed, say every 2 weeks. They take these funds, collect them, keep the basic records, and then turn them over to the larger groups such that the staff time is reduced. It makes it cheaper to lend, even in these smaller amounts. On the other hand, there are also now some important alternatives to joint liability that are increasing as an overall practice in microfinance institutions, and we'll examine those in the next episode.